Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you the difference between a long condor and an iron condor. I get a lot of questions on that, and it can get confusing. And also, when you look at the two structures, the risk profile, they kind of look similar. So I'm going to go through and show you the difference between a long condor and an iron condor. So first off, here's Boeing, and it's kind of has a breakout trade here. So you can see that the price action is broken to the upside, so it could go higher to the upside, or again, it could go to the downside. So one way that I like to play this quite a bit is we like to use long condors. And in this situation, a long call condor, so for a potential move higher, but it gets stuck in a range, so it has potential, if it stays between a certain range, to make a really good high return on very low risk. So that's a long condor. And then we're going to compare that to the iron condor, which is also a range-bound trade, but it's doing two credit spreads to take advantage of the spread or the trade or the price staying within this specific range. So let's compare the two and see how they are different. So this is Boeing, this is a long condor. So this is going to be a long call condor spread. And so it's based on today's date, the 10th. And at this point in time, when I set this up to show you the risk profile, it was trading at 211.92. Now, what this trade does, you can see down here where my pointer is. If you look at it, this is going long at the $210 call, and then you're selling the 215 call. Okay, so that's a call debit spread, but then you're also selling above, out of the money, the 225 call and buying the 230. So you have a bear call credit spread. So you have a call debit spread and a bear call credit spread here. All right. And at that point, it was trading at 211.92 or 212. Now, if you look at the potential here, you can see the max risk is the debit paid, $189. But the potential profit is the spread width, $5 less that risk. This could make $311 per spread, and that would be a great return on your capital at risk. So that would be a return of 165% if it traded between the two spreads. So let me show you what the risk profile or the spread looks like. So here you've got the call debit spread side here. So this would be long the call at 210, then short the call here at 215. Okay, so that's a call debit spread. And then you're selling further out of the money. You're going to sell the 225 call short here and buy the 230 above it. Now, this zone here is if at expiration, this is set for the 19th of February. If it goes out anywhere inside the two spreads, you'll make $311, and that's 165% return. All right, so that's the beauty of it. And also it has a positive theta, so we have that advantage as well. Now, the next one I'll show you is the iron condor, and you can see the risk profile down here below. But let me switch over to show you the dynamics or the difference between the two. So this is the Boeing iron condor. So a lot of times this is referred to as a probability trade. Now, look at the difference though. You can see your max risk here is actually $396, and the max profit is just the credit received. So this is a credit spread, two credit spreads, and the maximum profit would be the credit received. So here you can see you'd be selling the 225 call, buying the 230. There's a bear call credit spread, and then you're selling the bull put credit spread, the 200 short put, and buying the 195. The total profit on this would be the credit received of 104, and you've got a potential risk here of $396 and only a potential return of 104. So the potential return here would be a 26% return, and this is also what we call a negative risk ratio. So you're risking more than what you're going to make, and the reason for this is what it's termed as a probability trade, looking at probabilities based on the delta of the option. So referred to as a probability trade because if you sold short this, so selling short this 225 call strike here, you can see this is probability where my pointer is. That's the theoretical probability out of the money. So there's an 82.81% probability theoretically that the price of Boeing would close below $225 over the next 9 days. Okay, so that's a high probability of that happening. But again, it's theoretical. And then if you look at the put side, the short put here, the 200 strike, it has a probability of 81.47. So the probability of this closing above 200 is 81.47%. So that's why you get that less of a profit versus the risk, because of the higher probability theoretically for this to stay within that range. And here's what it looks like. So the risk profile looks very similar, right? But it's two credit spreads here. So this would be short the 225 call, long the 230, and then here you're you're short the 200 put and long the 195. So 2 credit spreads versus the other one, you're long a debit spread, short a credit spread. And here your maximum profit is if it closes inside the 2 short strikes here, you would make the maximum of $104 of total credit, and your potential risk though is $396. All right, so the potential is actually a higher amount of risk dollar-wise, but again, the probabilities theoretically are greater chance that it'll close in here. So it gives you the benefit of, 2 different types of range-bound trades, and my kind of preference is I like the call Condor or the put Condor because of that positive risk ratio that you get. So in summary, you can see here, this one is the long call Condor, so your potential profit is $311. Your risk is $189, so it's a positive risk ratio. You're risking less to make the $311 max profit, okay? And that would be 165% return. And then this is the Iron Condor. You can see your max profit here is the credit received $104, but you have a potential to lose $396, so a negative risk ratio. So I hope this helps, and if you'd like to learn more, make sure to join us at powercycletrading.com.